welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends that we've been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm your host, Carl Millard, Investment Manager based out of our Leicester office, and this week I'm pleased to be joined by Richard Carter, our Head of Fixed Interest Research, and Ben Barringer, Head of Technology Research. Good morning to you both. So, Ben, if I can come to you first. There's been a lot in the press recently around the valuation of US technology and AI stocks and concerns these are in a bubble. At the moment, the top 7 largest firms in the US stock market, Nvidia, Apple, Microsoft, Google, Amazon, Broadcom, and Meta, make up around 36% of the S&P 500, with Nvidia now valued at $4.5 trillion. Amongst a myriad of others, we've recently saw the Bank of England in one of its market risk reviews saying that the value of AI companies appears stretched and that there is a rising risk of a sharp correction. This was alongside Jamie Dimon, the CEO of JP Morgan, saying that he is worried about a serious market correction, though his timescale was over the next 6 months to 2 years, so quite a large timescale there, and that some of the money invested in AI would probably be lost, though he did also say that AI in total will pay off. So we've seen some volatility and weakness return in this area recently, with some quite sharp intraday swings in the US stock market seen towards the end of last week, arguably due to concerns over these tech valuations, leading to a more negative sentiment, alongside concerns over whether interest rates will be cut further in the US this year. So firstly, Ben, can I get your view on whether these AI technology stocks are in a bubble, if they are justifying their current valuations, and maybe tie that into your thoughts on Nvidia's results last week?
Golly gosh, Carl, that's a lot to get through, but let me try and break all of that down. Very good. So yeah, look, 3 years ago we were much more positive on technology because we really saw this AI opportunity unfolding. And as we go through the sort of months and quarters, obviously we're very careful to monitor reality and expectations, because all technologies, when they are introduced, go through what generally is referred to as a hype cycle. That doesn't mean it's all hype. It just means that we have to really closely track reality and expectations. Back in '99, when I started this job, there were expectations got way out of line with reality. There have been other technological, revolutions, the smartphone, cloud computing, where actually expectations stayed much more in check. So we've got to be very careful with AI that we keep things, grounded. I think that's the first thing. So 3 years ago, we were much more positive. At the beginning of this year, we moved our positioning back to more in line. And remember, we're really focused on buying quality companies at reasonable valuations. And so you can buy some of the bigger tech names on reasonable valuations, sort of 25, 28 times earnings. That, considering they're growing sort of mid-teens or 20%, we think is justifiable. And I think that's very important. Now, remember previous bubbles like the Nifty 50 back in the 1920s, that was 45 times peak earnings. In '99, the internet bubble, that was 60 times peak earnings. And Japan was sort of 72 times. So we think valuation is actually not that excessive. Now, in all technological revolutions, there are going to be some companies that are at very high valuations. Probably the most obvious is OpenAI, which is actually private, so you can't actually buy publicly quoted shares in it, but that trades on a valuation of sort of 500 billion with revenues of only 13, maybe 20 billion, something like that. So a very, very high valuation at OpenAI. And there are some other companies I would look at like Palantir or maybe CoreWeave that are on very high valuations. But those are not in our coverage and those are not in our models, because what we're trying to do is find consistent growers rather than these very, very fast growing companies that then decelerate and derate at the same time. So we're trying to stay very prudent and sort of pragmatic in terms of tech. Let me just talk about as well, because probably 8 weeks ago, I started to see the signs that people were getting a bit nervous around AI, and so we've done a little bit of profit taking. We've made sure we're really sure about where we're invested. But there is much more of a balance now between the negatives and the positives. Some of those negatives, I would say, you talked about the market concentration. Actually, a lot of that market concentration is backed up by the profits. So it's a lot. The sector is a lot more profitable than it was back in '99. So profitability is a lot stronger, but it is still a concern. There's this thing called vendor financing, i.e., are the customers being financed by the companies selling the products? That was an issue back in 1999. We think that that's not a great look, but we also think that companies like Nvidia are investing in OpenAI because they see a really good opportunity. And so, not a good sign, but I don't think a reason to panic. CapEx continues to be very, very strong in the data center area. Last year, CapEx growth was sort of 50%. It's going to be about the same this year. And then in 2026, those numbers have been rising. So CapEx growth next year is going to be about 30-ish%, something like that. And we're now thinking about 2027, and is the growth going to continue? And initial estimates of 2027 growth are for CapEx growth of around 15%. So when I'm thinking about valuations of technology companies, I'm trying to baseline it against that sort of 15% growth. So I think that is, we're reasonably balanced. So I'm not too concerned, but I'm trying to stay prudent. The things I would point on the positive side of the ledger, I've already talked about valuations, we think being pretty reasonable. There's good sort of earnings momentum. We saw continued upgrades over the earnings season. And also a lot of this CapEx, in fact, the CapEx is only 70% of the operating cash flow of these large hyperscalers. So that means this is not largely going to be debt financed. Now, there have been some debt issuances by companies like Oracle and CoreWeave, and a few by Meta and Amazon. But in the main, balance sheets still remain very strong and not levered, in our opinion. So again, another reason to avoid those sort of more satellite businesses, those higher value businesses, is again because they're having to finance from debt, not from cash flow. So look, final thing to say, what really would give us cause for concern of a bubble would be any deceleration we'd see in IT spending, any deceleration we'd see in digital advertising, and any slowing in that CapEx trend, more than than is expected to be natural. Again, 2027, we're expecting sort of 15% CapEx growth. So look, long answer to a long question, but hopefully that's given some context to some of those issues. The problem with bubble narratives and sentiment is that sometimes it can be self-feeding, particularly in the news world that we live, where there's a lot of clickbait. And there was a very good interview with the CEO of Google, and he talked about some of the difficulties in the market, but that was in the context of quite a lot of positives. I'll leave it there.
Thank you, Ben. So I suppose the message is the importance of being selective, looking at the fundamentals of these companies, and we've got the strong earnings predicted for 2026 and 27, and really getting the difference between profitable and unprofitable tech, I suppose, is the message there. So we've seen a number of firms open strategic partnerships with AI firms, mostly recently with Intuit, the business software company, signing a multi-year $100 million contract with OpenAI. Do you think this trend will continue? And is this actually showing and demonstrating the size of the deals and the investment that's happening at the moment?
Yeah, look, I think this is a really interesting point, and we watch this quite closely. So OpenAI had about 7 weeks ago their developer day, and what they were really talking about is how developers at other companies can embed OpenAI's technology into what they're doing. And early adopters of that have been Booking, the travel app and website, companies like Spotify, and then, as you rightly point out, Intuit. And what they're really trying to do is broaden, I think, the capabilities of ChatGPT. If you can think of ChatGPT as a sort of a gateway into your usage of the internet and technology, a bit like Google is at the moment, then what you want is access to the best sources of information, and let's assume that Booking and Spotify and Intuit are the best sources in their particular, sort of verticals. So yeah, I do think these are interesting. They also help to dispel some of the sort of bear cases that are out there around companies, particularly software companies like Intuit, where ChatGPT could be disruptive to their sort of revenues. We don't think that's the case, actually, for a number of reasons. One, Intuit has very good data on their customers, which they're not sharing with ChatGPT. Second of all, if you're going to be disrupted, Intuit mainly deals with small entrepreneurs. Those guys have just not got the time to sort of do their own accounting systems or do their own tax systems and so forth. And so we think that they're a reasonably secure area of the market to be invested in. Now, the most obvious company that we think is getting disrupted is Google. Because Google has been that gateway. Now, Google is also innovating very quickly as well. And so since the DOJ court case, which had very limited remedies for Google in terms of market dominance, Google has been innovating very, very hard, and they've just released Gemini 3. That version of their large language model, their generative AI model, has received good reviews. And so the best way to keep customers is to have just as good an innovation as ChatGPT. So this to and froing of model releases is going to continue into the future. The real beneficiary is actually going to be consumers, because they're going to get really good models from both ChatGPT and from Google. And there are some other good models from companies like Anthropic. So we're still at the early stages of working out which models are going to be dominant. And it's probable, actually, that some people will use some models for one thing and some models for another thing. That's happening at the moment. If you're using an app, you're probably using ChatGPT. If you're using Google search and then you want some AI, you're probably using Gemini. And then if you're doing coding within an enterprise, a company called Anthropic, their Claude algorithm is probably the most dominant there. So yeah, it's still early days, lots to keep an eye on, but disruption, but also partnerships, I think are very good to watch. So it's right to identify that. Thank you.
Thank you. And just lastly, just to clear up some terminology that our listeners may have heard, can you explain the term hyperscaler and what an AI data center is, please?
Yeah, so hyperscaler really means a company that is has the resources to produce massive data centers. So the big three hyperscalers are, in order of size, Amazon Web Services, part of Amazon.com, Microsoft Azure, part of Microsoft, and then Google, which has Google Compute Platform, or GCP. Those are the big hyperscalers. It's classically been a three-player market. Now, as some other, particularly AI use cases have come in and there's been shortage of capacity, companies like Oracle and another company called CoreWeave have also sort of joined that party, but they're still very much sort of subscale. The Amazon and Microsoft really dominate this area. And the other thing that's worth saying is these are hyperscale, so they're very, very large data centers. It used to be that a big data center was sort of 10 megawatts, 100 megawatts of energy usage. Now we're moving to gigawatt and even multi-gigawatt data centers. And so these are taking up hundreds, sometimes even thousands of acres of space. So if you Google a thing called Abilene in the US, that's the big Oracle data center that is going to be a gigawatt or more. So it's requiring very large power resources and a lot of space as well.
That's great. Thank you, Ben. Appreciate this is a huge subject at the moment. So I would highlight there is a recent chat with Ben, Decoding AI and the Future of Technology, with my colleagues Jonathan and James, and also his note, Tech Bubble 2.0, all on the Quilter Cheviot website under News and Views. So it's finally budget week, and we will see what that brings on Wednesday. As a reminder, we have our webinar at 10 a.m. on Thursday, the 27th of November, to provide our reaction and discuss the implications to what is announced and how it impacts our outlook for investment markets. If I can turn to you, Richard, what has been happening in bond markets, especially in the run-up to the budget? Does that give us a clue into what's expected to be announced?
I'm not sure it gives us a massive clue, Carl, but there's enough, there's as much uncertainty in bond markets about what's going to happen as there is probably in the media and the press. I mean, actually, gilts had been doing okay a few weeks ago because the inflation data, the wages data was getting a bit better. It suggested that the Bank of England was going to be more open to cutting rates. And it also seemed like the government was very much set on, sticking to the fiscal rules, and if necessary, breaking manifesto promises to do it. Raise income tax and all the rest of it. So, so markets were kind of, or at least gilt markets, sort of fairly reassured by that. But then, unfortunately, it's a bit of a characteristic of the government. There was a sort of another U-turn, more flip-flopping, and it sounded like income tax actually wasn't going to go up. They said because it wasn't going to be necessary. You've also had, sort of worries about Starmer's leadership and all the rest of it. So we've seen a bit of a reversal. Gilt yields have gone back up, but we shall wait and see what happens in the budget. I mean, I think they'll make the numbers add up on the day. They'll meet their rules. They'll get the headroom back in sort of reasonable shape. That's to be expected. The question is, are the measures credible, sustainable? Do they help the economy grow? Do they get inflation down? Or is it just a bit of a mess again? And think, you can't believe some of the things that they're promising to do, particularly around maybe any spending cuts. And are we just going to be back here in a year's time with the same old problems? So that's really what we'll be watching for, I think, in the budget. Certainly very important for gilts. Although, there's other things going on in the world that will drive gilt markets as well, but the budget clearly is very important.
Okay, thank you. Well, talking of inflation, what impact do you think the UK inflation figures announced last week with CPI falling to 3.6% will have on the Bank of England's interest rate decisions going into next month and the end of the year?
Yeah, no, the numbers are okay, sort of roughly around expectations, actually. I mean, the good thing is that inflation does seem to have peaked. It's gradually coming down, not just headline CPI, but the core part of it as well, services as well. So that is good. The MPC, the Bank of England's interest rate committee, is very split at the moment. Last time around, they voted 5-4 not to cut rates. Maybe next time they might vote 5-4 to cut rates. I think that's probably, that's definitely a possibility. We'll see what happens in the budget and if that drives any changes. But at the moment, they do look on course to be cutting rates one more time before year end. So that's good. And I think, I think in the budget, we've heard things about not putting rail fares up next year. I think everything that Rachel Reeves tries to do will be to bring inflation and inflation expectations down and encourage the Bank of England to cut rates, because that means that the government borrowing costs should come down as well. So I think that will be a big theme in the budget.
Okay, great. So just lastly then, can you let us know what's been happening in the US around interest rate expectations? The jobs data was out last week, and I think that's been impacting markets as well. So any thoughts on the US?
Yeah, we had a bit of a hiatus when the government shut down. We didn't get much data for a while. We're starting to get that now, albeit some of it is a bit distorted, a bit out of date, to be frank. Those September payrolls you mentioned were kind of fine. Payrolls were stronger than expected, but the unemployment rate went up. So something in there for everybody, really. We're still waiting to get more figures out before the next Fed meeting. But some of the chatter from Fed officials suggests a few of them are open to cut rates in December. It's not a done deal by any stretch of the imagination, and we'll see what the rest of the data does. But certainly looks like there's a good chance of a rate cut in December.
Okay, thank you. Well, that about wraps us up for today. Thank you both for those great insights, and to all of you for listening. Did you enjoy our discussion on the podcast today? We'd love to hear from our listeners, so please review the show now wherever you're listening, share it on your socials, and tag us at Quilter Cheviot. To make sure you don't miss a future episode, please also tap the subscribe button. We'll be back next week. In the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview, as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars. Also on our website and our social media pages. Reminder again, we have the budget webinar on Thursday at 10 a.m. Finally, do you have any questions you'd like to ask one of our experts for our next podcast? Simply ask them via the weekly comments page on our website. We'd love to hear your questions. And that's it for today. So thank you, Richard and Ben, for your time, and all of you for listening. See you next time.